A strong financial market with widespread participation is the backbone of a thriving economy. With this vision in mind, India launched its first mutual fund, the Unit Trust of India, in 1963. This initiative, led by the Government of India and RBI, aimed to promote saving and investment habits among the public while allowing them to share in income, profits, and gains generated by the fund's investment in securities. In recent years, the mutual fund industry in India has experienced remarkable growth, reflecting its increasing importance in the financial landscape. In this video, we will deep dive into what exactly mutual funds are and the different types of mutual funds. We'll explore the jargons and terminologies used in mutual funds. Then we'll cover the advantages and disadvantages of investing in mutual funds. Furthermore, we'll cover what's behind the remarkable growth in mutual funds. Lastly, we'll provide insights into when it's the right time to sell your mutual funds and conclude with key takeaways and insights. Let's begin. You're watching Informed Investor, an initiative by Equentis. Now, what exactly is a mutual fund? Imagine you want to invest your money but aren't sure where to start. Investing can be risky and complicated, especially if you're doing it on your own. This is where mutual funds come into play. Think of a mutual fund like a big pot of soup. Each ingredient contributes something to the pot. A professional chef carefully selects the ingredients and blends them to create a balanced soup. In case of mutual funds, these ingredients are stocks, bonds, or other securities. By pooling their money together, investors can enjoy a well-diversified investment portfolio without needing to be the fund managers themselves. Now, before delving into details of this topic, it's important to know and understand some of the commonly used terminologies of mutual funds. First is net asset value, or NAV. NAV is the per unit price of a mutual fund. It is calculated by dividing the total assets of the fund minus its liabilities by the number of outstanding units. NAV is usually computed at the end of each business day based on the closing market prices of the fund's securities. For our reference, we'll look at the HDFC FlexiCap Fund, which has a NAV of Rs 1,926, meaning 1 unit of the fund is priced at Rs 1,926. Next is AUM, or rather assets under management. It is the total market value of the investments that an asset management company is managing on behalf of its investors. In this case, the HDFC FlexiCap Fund has an AUM of fund size of Rs 54,692 crores, which means that the fund manages assets worth Rs 54,692 crores. In context, higher AUM indicates the fund's popularity and size, but it doesn't necessarily translate to better performance. Next is expense ratio. The expense ratio represents the annual fee that mutual funds charge their investors to cover the fund's operating expenses. These expenses are items such as sales and marketing or advertising expenses, administrative expenses, transaction costs, investment management fees, registrar fees, custodian fees, audit fees, which are charged as a percentage of the fund's daily net assets. Lower expense ratios are generally better for investors as they reduce the overall cost of investing. In this case, the expense ratio is at 0.76%, meaning that the fund deducts 0.76% from the AUM as operational expenses, referred to as an expense ratio. Another point to highlight is that funds which replicate the index in case of index mutual funds tend to have a lower expense ratio as compared to an active mutual fund where the portfolio manager has to actively monitor and rebalance the fund as per his discretion. Then comes exit load. Some mutual fund schemes charge an exit load on redemptions or cancellations within a stipulated time period. Exit load is like a penalty for premature redemptions because it is meant to discourage investors from selling their mutual fund investments too soon. Mutual funds are not meant for short-term investments unless you're parking your surplus cash in a liquid fund. Since mutual funds are subject to market volatility, they are best suited for medium to long-term goals. Hence, most mutual fund schemes, except liquid funds, charge an exit load if investors sell their investments within the stipulated time period. Exit load is charged as a percentage and is applied on the redemption amount. For example, if exit load is 1%, then you'll receive 99% of your redemption amount if you sell your investment before the stipulated period. Exit load as a percentage is applied on NAV applicable to your redemption. If the NAV at the time of redemption is Rs 100, you will receive only Rs 99 for each unit of mutual fund investments you decide to redeem. Next up is CAGR, or compound annual growth rate, which represents the mean annual growth rate of an investment over a specified period longer than 1 year. The main point to note is that it takes into account the effect of compounding, which means that the growth builds upon itself. Another point is it smoothens out the effects of volatility and provides a single annual return rate that an investor can expect over the investment period. The formula for CAGR is displayed on the screen. Let's understand this through an example. Suppose you invested rupees 1 lakh in a mutual fund and its value grew to rupees 1,50,000 over 5 years. The CAGR would be calculated as shown on the screen. So, the investment grew at an average annual rate of approximately 8.447%. Another term to calculate the annualized returns is through the XIRR or Extended Internal Rate of Return method. Unlike CAGR, which assumes a single lump sum investment, XIRR considers the timing and size of each cash flow, making it ideal for evaluating systematic investment plans or investments with irregular cash flows. The XIRR formula is more complex and typically requires a financial calculator or spreadsheet software like Excel to compute. Let's take an example to depict this. Consider you have the following cash flows in a mutual fund. Using the XIRR formula, where the cash flows are in column C and dates in column A, you would get an XIRR of approximately 8.16%, indicating the annualized rate of return for the uneven cash flows over the investment period. Next is indexation. Indexation is the process by which purchase price of assets like gold, real estate, and debt mutual funds are adjusted to reduce the impact of inflation while calculating return from these investments. In simple terms, indexation results in lower tax payout for debt mutual fund investments. If you still haven't understood, we'll explain this clearly when we talk about taxation of debt mutual funds. Now let's understand how exactly a mutual fund works. When you invest in a mutual fund, you're pooling your money with many other investors. The fund issues units based on your investment amount at the current NAV. Since the market value of the securities changes every day, the NAV also changes daily. Unlike stock prices that fluctuate throughout the day, NAVs are calculated at the end of each trading day after the markets close. For most mutual fund schemes, units are allocated based on NAV declared at the end of the trading day. Returns from the mutual fund can include income distributions derived from dividends, interest, capital gains, or other earnings. If you sell your mutual fund units for a higher or lower amount than your initial investment, you may realize capital gains or losses accordingly. Now, coming to the different kinds of mutual funds. Mutual funds come in various types, each designed to meet different investor goals. They can be broadly classified based on several factors like organizational structure, management of the portfolio, meaning whether the fund is actively or passively managed, investment objective, asset class, thematic goals, ETS, etc. Out of these, we will focus on the most popular types of mutual funds, which are those classified based on asset class, thematic goals, and investment objectives. First up is equity funds, often called stock funds, are like the adventure seekers of the investment world. They pool money from a diverse group of investors and dive into the stock market, buying shares in various companies. The returns depend entirely on how these shares perform. While they have the potential to deliver significant gains over time, they also come with a higher chance of risk, making them a choice for those who are ready to take high risk. Let's explore the different types of equity mutual funds. First is large cap funds. These are basically those funds that invest in large, well-established companies with a high market capitalization. These funds are considered relatively stable with moderate growth potential and lower risk. If you look at the chart, you'll see that these large cap funds offer an average return of about 37%. Mid-cap funds focus on mid-sized companies with a medium market capitalization, and they offer a balance of risk and return, providing more growth potential than large-cap funds but with higher risk. The average CAGR of the mid-cap funds are about 68%. Small-cap funds invest in small companies with lower market capitalization. These funds have high growth potential but comes with higher risk and volatility. The one-year CAGR of most of the small-cap funds lies between 50 to 72%. Multi-cap funds invest across companies of different market capitalizations, including large, mid and small caps, and offer diversification and balanced risk and return. The average CAGR of the multi-cap funds are about 56%. Sectoral or thematic funds focus on specific sectors like technology or healthcare, or themes like ESG, that is environmental, social and governance. The risk in such funds is higher due to concentration in a specific sector, but can provide high returns if the sector performs well. The one-year CAGR return for these funds is the highest among all equity categories, averaging approximately 73%. Equity-linked savings scheme or ELSS have become increasingly popular in recent years. These schemes offer tax benefits under Section 80C of the Income Tax Act and come with a lock-in period of 3 years. ELSS encourages long-term investment in equities while providing potential tax savings. The average one-year CAGR for ELSS is 55%. Next is debt funds. These funds are designed for those who seek stability and regular income over high-risk, high-return adventures. They invest in fixed income securities like government bonds, corporate bonds, and other debt instruments. Let's dive into the various types of debt mutual funds. Liquid funds invest in short-term debt instruments with maturities of up to 91 days. They offer high liquidity and low risk, making them perfect for parking surplus funds for short periods. These funds offer an average one-year CAGR of 7.38%. Corporate bond funds invest at least 80% of their assets high-rated corporate bonds and usually provide higher returns than government bonds with slightly higher risk, with the one-year CAGR being 7.4%. Now coming to the next very important thing, mutual funds and taxation. Understanding how mutual funds are taxed involves looking at several important factors. Let me break it down for you. First, we need to distinguish between the types of mutual funds because this affects their taxation. Mutual funds are generally classified into equity-oriented funds and debt-oriented funds. First is equity-oriented funds. These funds invest mainly in stocks. They have specific tax rules that are different from debt funds. And debt funds invest in bonds and other fixed income securities. The way gains from these funds are taxed differs from equity funds. Next, let's talk about capital gains. This is the profit you make when you sell a capital asset for more than what you paid for it. In the case of mutual funds, capital gains are taxed differently depending on how long you hold the investment. Short-term gains. If you sell your mutual funds units within a short period after buying them, the profit is considered as short-term gain. Long-term gains is when you hold on to your mutual fund units for a longer period before selling. For equity funds, any investment held for less than 12 months is considered short-term. The gains from selling these are taxed at a rate of 15%. For debt funds, the short-term period is less than 36 months and the gains are taxed according to your individual income tax slab. For equity funds, if you hold your investment for more than 12 months, the gains are considered long-term. These gains are taxed at 10% if the total long-term gains from equity-oriented mutual funds or shares exceed 1 lakh in a year. Below this threshold, the gains are tax-free. For debt funds, earlier, investments held for more than 36 months were taxed at 20% after applying the indexation benefit. Indexation adjusts the purchase price for inflation, reducing the taxable gain. Without indexation, the tax would be higher. However, the Finance Act of 2023 removed this benefit for debt-oriented funds purchased after 1st April 2023. Both the long-term and the short-term gains on debt funds are now taxed at regular tax slabs. Equity-linked savings schemes or ELSS are a bit special. They are mutual funds that invest at least 80% of their money in stocks. Here's what you need to know about them. When you invest in ELSS, you can deduct the invested amount of up to Rs 1.5 lakhs from your taxable income under Section 80C of the Income Tax Act. Remember, the total limit for deductions under Section 80C is Rs 1.5 lakhs. If you have other deductions under this section, the deductible amount for ELSS will be reduced accordingly. ELSS has a mandatory lock-in period of 3 years. You cannot withdraw your investments before this period ends. After the lock-in, any gains are subject to long-term capital gain tax, not short-term. To sum it up, understanding mutual fund taxation means knowing what kind of fund you're dealing with, how long you've held it, and how profits and dividends are taxed. This knowledge helps you plan your investments better and take advantage of the tax benefit. Next thing we'll discuss is when to sell your mutual funds. Deciding when to sell your mutual funds can be crucial for maximizing returns and managing your financial goals. Here's a guide to help you understand the key scenarios when selling might make sense. First is goal realization. If you have reached the financial target you set when you invested, it might be the time for you to sell. For instance, if you invested in a mutual fund to save for a specific purpose, like a child's education or buying a house, you have reached that goal, consider liquidating your investments. Second is changes in fund performance. If your mutual fund consistently underperforms compared to its benchmark or peers, it might be a signal to sell. Poor performance could erode your returns over time. While a fund not doing well for a few months or quarters is common, you shouldn't be in a hurry to exit such funds. It is not rare for good funds to undergo short-term underperformance. Only when the underperformance continues for a long enough period, say 1 to 2 years, compared to its benchmarks and peers, and that too by a decent margin, should you consider exiting. Next is approaching retirement. As you near retirement, you might want to reduce exposure to equity funds to lower risk. Shifting to more stable, income-generating investments could be advisable. Next is change in financial situation. Significant changes in your income, such as job loss or salary reduction, might necessitate selling some investments to maintain financial stability. Then comes an out of favor investment style. It happens at times that a particular investment style falls out of favor. For example, over the last couple of years, growth funds have been lagging behind the value funds. In such a case, any fund that follows the growth style of investing will likely underperform. But it is important to know that investment styles, like everything else, have ups and downs. They experience both favorable and challenging phases. This should not be a standalone reason to exit a fund. However, here are some key considerations you must consider before selling. Exit load. Some mutual funds charge an exit load if you sell units within a certain period after purchase. Check for any such charges to avoid unnecessary cost. Capital gains tax. Be aware of the tax implications of selling your mutual fund units. Short-term and long-term capital gains are taxed differently, as mentioned earlier. Market conditions. Avoid making impulsive decisions based on short-term market fluctuations. A long-term perspective often yields better results. Now, why would someone choose to invest in mutual funds instead of directly in equities or other asset classes? Let's explore why mutual funds are favored by many investors and the advantages they offer. First is professional management. Imagine having a team of experts working full-time to manage your investments. Mutual funds are run by professional fund managers who have the expertise, experience, and resources to make informed decisions. They continuously monitor and adjust the portfolio to meet the fund's objectives. So, even if you don't have the time or knowledge to dive deep into individual stocks or bonds, you're still in good hands. Next is risk diversification. Think of mutual funds as a way to spread your investments across different securities and asset categories like equity, debt, and gold. This diversification means you're not putting all your eggs in one basket. If your investment performs poorly, others in the portfolio can balance it out. This way, even if one component faces a downturn, your overall investment is less likely to suffer significantly. Then comes affordability and convenience. Investing in mutual funds is like getting a bulk discount on a variety of investments. Instead of buying each stock or bond individually, you can invest smaller amounts in a mutual fund and still get exposure to a diverse portfolio. This makes it more affordable and convenient for many investors. Next is liquidity. In case of open-ended mutual funds, you can redeem your units on any business day. Depending on the type of scheme, the money is usually credited to your account within 1 to 4 days. However, keep in mind that close-ended schemes can only be redeemed at maturity, and ELSS funds have a 3-year lock-in period. Next comes low cost. Mutual funds benefits from economies of scale, resulting in a low expense ratio. This means the cost of managing the fund is spread across many investors, making it more cost effective for you. The expense ratio covers administration, management, and other operating expenses and is regulated by SEBI to ensure fairness. Now, as mentioned earlier, mutual funds in India are regulated by SEBI. SEBI has stringent rules and regulations to protect investors, ensure transparency, and maintain a fair valuation framework. This regulation adds a layer of security to your investments. Now, while mutual funds have their perks, they also come with their own set of risk. You've probably noticed those ads that always ends with a reminder that mutual funds are subject to market risk. Let's understand what that actually means and look at the key risks you should be aware of when investing in mutual funds. First off, there's no guarantee of income distribution, returns, or capital appreciation when you invest in a mutual fund. Your returns can fluctuate based on various factors. Investing in securities always involves some level of market risk. Mutual funds can be affected by changes in global, regional, or national economies, shift in political conditions or government policies, updates to laws and legal frameworks, general movements in interest rates, and overall market mood and investor sentiments. There are many other risks involved while investing in mutual funds, like liquidity risk or inflation risk, that is the risk that inflation could erode the purchasing power of your investment over time. Risk of non-compliance might also arise if the mutual fund or its managers don't adhere to the laws, regulations, or internal policies. Also, the fund's performance heavily depends on managers' expertise, knowledge, and investment strategies. any shortcomings in these areas can adversely affect the fund's performance. By understanding these risks, you can make more informed decisions and better prepare for the ups and downs of mutual fund investing. Now, what's driving the remarkable growth in mutual funds? India's mutual fund industry is booming, with assets nearing the 60 trillion rupee mark as of May. The Association of Mutual Funds in India reported that the total assets under management soared to 58.6 trillion rupees, marking the fastest rise on record. AUM refers to the total value of all investment managed by a mutual fund, asset management firm, or investment company on behalf of investors. This incredible surge, adding 10 trillion rupees in less than a year, highlights the growing confidence among investors and the robustness of the Indian financial market. It took 5 decades to accumulate the first 10 trillion rupees of assets since the industry's inception in 1964. However, the recent pace of growth is unprecedented, with the last 9 trillion rupees added under just 6 months, reflecting a dynamic market and increasing investor participation. One of the key drivers of the growth has been the influx into equity mutual funds. In May, these inflows jumped by an impressive 83% month-on-month, reaching 346.97 billion rupees. This surge indicates a strong investor presence for equity assets, especially small and mid-cap stocks, which have shown robust performance and attracted those seeking higher returns. If we talk about financial year 24, it has marked a pivotal moment for the domestic mutual fund industry, characterized by an extraordinary increase in the assets under management. So what factors fuel this success in financial year 24? The mutual fund sector saw its AUM grow by over 35% year on year, with the number of mutual fund accounts reaching a record 17.76 crore. Unique investors increased by 70%, adding 68 lakh new investors, bringing the total to around 4.46 crores. Retail investors also upped their investment amounts, with the average ticket size per retail account rising to Rs 84,890 in December 2023. The surge in retail participation is particularly evident in SIPs, which saw monthly net inflows of Rs 19,300 crores in March 2024, totaling nearly Rs 2 lakh crore throughout financial year 24. Now, where are these funds being invested? Let's break it down. Equity-oriented categories. These grew by 55%, reaching Rs 23.5 lakh crore in assets in financial year 24. Debt funds witnessed moderate growth of around 7% during the financial year, reaching Rs 12.62 lakh crore in assets after declines in previous fiscals. Hybrid funds recorded impressive growth of over 50%, reaching Rs 7.22 lakh crores in assets in financial year 24. In conclusion, the evolution of India's mutual fund industry from its humble beginnings to its current state has been nothing short of remarkable. The industry's exponential growth is driven by robust regulatory frameworks, increasing investor awareness, and a diversified range of investment options. As mutual funds continue to offer professional management, risk diversification, and affordability, they remain a preferred choice by many investors. Understanding key terminologies and their implications is crucial for making informed investment decisions. The rapid expansion of the mutual fund sector emphasizes its crucial role in the financial landscape, providing investors with an effective path to wealth creation and financial stability. This growth story highlights the potential of mutual funds to drive financial inclusion and economic progress in India. These trends are shaping the future of industry and are poised to continue making mutual funds an even more attractive investment options for the savvy investors. Having said that, this is Aditi Priya signing off.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.